Welcome to Iron Financial. I'm your lead analyst, and today we are forging a stronger portfolio by cutting straight through the market weakness, filtering out all the corporate spin, and looking directly at the hard numbers. We are performing an uncompromising line-by-line drill down into Meta Platforms' Q2 2026 earnings report. Look, this isn't your standard surface-level overview. We are looking for structural durability. We're analyzing debt loads, and we're determining whether management is welding capital effectively or if they're simply burning cash in a furnace. We are looking at a company that is pulling in historic, towering revenues, and yet its free cash flow has inexplicably evaporated. So remember to hit subscribe and smash the like button so you don't miss a single blueprint for building a bulletproof portfolio. Because this explainer is going to heavily stress test every single beam of Meta's latest quarter to see if it actually holds up under pressure.
And I'm your market skeptic, representing everyone watching who just wants the brutal truth. Is this AI hype or is it actual tangible value? Because right off the bat, we've got to talk about the massive cracks we're seeing in the armor here. On one side, we've got a towering revenue surge up to $60.80 billion. That's up an absolutely impressive 28% year over year. But on the other side, free cash flow has completely collapsed to just $784 million.
Exactly. And that is a massive red flag. You don't build a skyscraper without pouring serious capital into the foundation, sure. But a drop to under $1 billion in free cash flow, when you are simultaneously pulling in $60 billion in top-line revenue, that requires an immediate, emergency structural inspection. When a tech giant is operating at this kind of scale, that level of cash evaporation tells us that the cost of maintaining the building is suddenly rivaling the rent being collected. We need to find out exactly where that money is leaking.
All right, here's our inspection blueprint for this explainer. 1. Top-line stress test. 2. Operational health. 3. Segment pillars. 4. The heavy lifting. And 5. The verdict.
Phase 1. Top-line stress test. Revenue versus structural bloat.
Let's start with the solid steel holding this entire structure together right now. Meta reported Q2 2026 revenue of $60.80 billion. Again, that's a 28% increase year over year. That revenue is heavily supported by their advertising dominance across all geographies. The sheer demand from advertisers is the undeniable force holding this top line together. In simple terms, businesses globally have virtually no choice but to spend their marketing dollars here if they want to reliably reach customers. And honestly, on a constant currency basis, if we strip away all the foreign exchange fluctuations, that revenue would still have been up 27%. The sheer top-line force Meta is generating right now is undeniable.
I totally agree. I won't deny the top-line strength. $60 billion in a single quarter is a massive structural beam, and it proves the ad market is highly resilient right now. But honestly, what good is a strong beam if the bolts and rivets holding it together are rusting out from the inside?
Because when we move past the revenue and examine the expense side of the ledger, I see severe structural bloat. Total costs and expenses for Q2 surged by a staggering 55% year over year, landing at $42.03 billion. Included in that absolute wreckage is a massive $2.40 billion legal charge and another $1.18 billion in severance from the May 2026 layoffs. We really have to ask ourselves, is this just a one-time cleanup of the operational core, or is management hiding deeper structural flaws behind these numbers? And that is the defining question for investors right now. Look, the $1.18 billion severance is the painful but necessary cost of retooling the workforce. It's cutting away the excess scaffolding to make the core business leaner. But that $2.40 billion legal hit, that is a material fracture. And management has explicitly warned that upcoming youth-related trials in the U.S. could result in further material losses. For anyone tracking institutional investment, Wall Street absolutely hates unpredictability. A reoccurring legal liability isn't a one-time storm, it's a permanent structural weakness that scares off the heavy institutional capital needed to drive the stock higher. That is a recurring risk we absolutely have to price into the foundation of this asset.
And all of this bloat brings us to this hard number right here, 31%. Because of this 55% surge in expenses we just talked about, Meta's operating margin was severely compressed, dropping from a highly lucrative 43% all the way down to 31%. Operating income actually declined 8%, despite the massive revenue surge we just looked at.
And for those watching who might be newer to this, operating margin is essentially how much profit they get to keep from every single dollar they earn from their core operations, well before taxes and interest come into play. Dropping 12 percentage points, going from 43% down to 31%, means the fundamental cost of doing business is getting drastically more expensive. When your top line grows 28%, but your operating income actually falls, it means the cost of heavy lifting is severely compressing your margins. You're literally working harder just to make less money.
Moving on to phase 2, operational health. User base and monetization. Let's see if the core engine can offset this bloat. The base foundation of this entire company, the concrete slab it's all built on, is its user base. For Q2 2026, Family Daily Active People, or DAP, hit 3.60 billion on average. That is a 3% increase year over year. It's a massive number. I mean, effectively half the planet is logging in every single day. The foundation isn't crumbling, but at only 3% growth, it's pretty safe to say the concrete is fully cured. Because they've reached this incredible saturation point, it forces a massive pivot in corporate strategy. They can no longer rely on endless user acquisition to drive revenue. Now they have to rely entirely on ruthless, hyper-efficient monetization of the users they already have locked into the ecosystem. Which is exactly why this next data point is the most critical joint in their monetization engine. If you can't grow the user base by double digits anymore, you have to squeeze much more value out of the existing digital real estate. And to their credit, Meta is doing exactly that. Ad impressions delivered increased by 14%, and crucially, the average price per ad rose by 12%.
Okay, I have to admit that is some impressive engineering right there. Getting a 14% increase in volume while simultaneously commanding a 12% increase in pricing power, that's actually really rare. And the reason commanding a higher price per ad is the ultimate sign of a healthy platform is pretty simple. Advertisers are totally ruthless with their budgets. They would never agree to pay 12% more for an ad unit unless they were getting a definitively higher return on their investment. So that tells me Meta's ad pricing power is absolutely holding up the revenue beam, even as that user growth flattens out. And the reason those advertisers are seeing that tremendous return on investment brings us to the AI reinforcements. Mark Zuckerberg stated that AI is actively accelerating the core business, and frankly, the hard data backs it up. This isn't just vaporware or some futuristic promise. They are actively welding AI directly into the core products right now. Large language model-powered recommendations drove a highly significant 15.7% increase in Facebook ad conversions alone.
See, I honestly expected their AI tools to just be corporate buzzwords to appease Wall Street. We see it literally everywhere in the market today. But a $75 billion annual revenue run rate on their Advantage Plus products, that proves this tech is actually printing money. This isn't theoretical. It's genuinely driving advertiser results today. Plus, over 9 million small businesses are now using at least one of their AI creative tools. I'm usually the skeptic in the room for sure, but this shows AI is forging real value and cementing their moat.
Phase 3, segment pillars. The profitable versus the cash furnace. The visual disparity here physically hurts to look at. In one corner, we have the family of apps, an absolute fortress generating $60.37 billion in revenue and a phenomenal $23.39 billion in operating income. It's an unstoppable cash machine. But in the other corner, we have Reality Labs. It generated a microscopic $431 million in revenue while incinerating cash to the tune of a $4.62 billion operating loss in a single quarter. It's a cash furnace. There is absolutely no other way to frame it. The incredibly profitable family of apps pillar is completely subsidizing this highly speculative structural addition. Reality Labs is aggressively dragging down the overall operating margin we discussed earlier, and management is showing zero signs of turning off the gas to this furnace anytime soon. They are 100% committed to building out the metaverse and spatial computing, completely regardless of the immediate drag on the bottom line.
Phase 4, the heavy lifting. Cash flow crunch and capital expenditures.
I want every investor watching to let this next metric fully sink in. Cash flow from operations came in at a massive $31.86 billion. That is the raw cash generated by the business. But against that, capital expenditures were $31.08 billion. Let that sink in. They spent almost every single dollar they generated from operations on CapEx, buying NVIDIA chips, building massive data centers, powering servers, and constructing AI infrastructure.
And this right here is exactly why free cash flow collapsed to just $784 million. That leaves free cash flow, which is the actual unencumbered cash a company can freely use to pay dividends, buy back stock, or weather an economic storm, dangerously thin. A year ago, free cash flow was $8.55 billion. This isn't just heavy lifting anymore. This is management aggressively mortgaging the present to build an AI infrastructure fortress for the future. But are they spending too aggressively? When your CapEx practically mirrors your operating cash flow, investor patience is going to be severely tested.
To answer if they are spending too aggressively, we have to stress test the balance sheet integrity. Can the financial foundation actually support this unprecedented level of capital intensity? Well, they currently have $90.26 billion in cash on marketable securities on hand. Against that, they have $83.66 billion in long-term debt. So effectively, they're net cash positive. For anyone new to stress testing a balance sheet, being net cash positive simply means that if the company had to pay off every single dollar of its $83.66 billion in long-term debt tomorrow, they have enough cash on hand to do it and still have a few billion left over. That gives them a much wider margin of error than a smaller tech company could ever dream of. So the foundation isn't cracking under the debt, but they are absolutely burning through their cash buffers at breakneck speed to fund this massive CapEx surge. Now let's review management's forward guidance blueprint to see where they are actually pointing the ship. For Q3, they expect revenue between $61 billion and $64 billion, which does imply a slight deceleration in the top-line growth rate compared to what we just saw.
But what really concerns me is the rest of the board. They raised the lower end of their full-year 2026 expense range to $165 billion to $169 billion, specifically to absorb those looming legal hits we talked about. Even worse, they narrowed their full-year capital expenditures guidance to a jaw-dropping $130 to $145 billion, up to $145 billion. Listen, when you commit $145 billion to infrastructure, you are effectively locking the company onto a single high-stakes trajectory. There is no turning back, and there is a massive opportunity cost. That is $145 billion that isn't going to shareholders, isn't buying competitors, and isn't shoring up defensive reserves. Add in an expected tax rate hike up to 15 to 17%, and the squeeze on overall profitability is only going to get tighter from here on out.
Phase 5. The verdict. AI fortress or capital trap?
Here is the ultimate question for everyone watching to consider right now. With up to $145 billion committed in CapEx and current free cash flow shrinking to under $1 billion, is Meta successfully building an indestructible AI infrastructure fortress that will unequivocally dominate the next decade of computing? Or is this an over-leveraged capital trap where management is simply spending way too aggressively, ignoring the looming legal liabilities, and wearing out investor patience in pursuit of a tech utopia?
Here is the definitive iron financial verdict based strictly on the hard numbers and the structural integrity we've inspected today. The rating is a hold. Make no mistake, the foundation of this company is solid steel. The ad revenue engine is exceptional, their pricing power is up, and AI is undeniably driving real, measurable conversions for advertisers today. However, the cost of the heavy lifting is severely compressing the margins. The 55% operational expense bloat, the massive recurring legal liabilities, the multi-billion-dollar cash furnace that is Reality Labs, and the sheer capital intensity of spending $31 billion in a single quarter just on infrastructure means there are significant risks permanently welded into the stock right now. Until we see that monumental CapEx actually translate into massive bottom-line free cash flow growth, you hold your position and wait to see if the concrete settles without cracking. But we leave you with this. If Meta's $145 billion AI bet actually pays off, will they completely monopolize the next era of the internet, or will this go down as the most expensive miscalculation in tech history? Let us know your thoughts in the comments below. Thank you for joining this explainer, and we will see you on the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.